Hello, welcome back to Passive Income Pilots, everyone. Tait, Duryea, and Ryan Gibson. How you doing, Ryan?
I'm doing great. It's been a great start to the summer. Done some flying in the plane. I think last time we talked, I was heading out to the ranch, and
You were.
yeah, and we're going to have the Jim Richmond Foundation on the podcast coming up. So if you're a backcountry pilot and you want to learn how that all works and the mechanics behind that, they're actually going to come on the show here. But anyway, I had a great time. Flew down to the ranch and did some backcountry flying and did some fishing with the family. So
Oh, amazing.
fun to be back. Yeah.
That's fantastic. Yeah, we've been kind of had our heads down so far this year. I'm excited to get off site in a little while here, and we're headed over to Europe. We're doing a half marathon in Chamonix in a couple of weeks, and I'm
Nice.
super excited for that. But
I do the Ragnar relay every summer.
that's right. I got to come out there and do that with you.
Yeah, July. I think it's 10th and 11th in the Pacific Northwest Passage. Got a team this year, and usually we take second or third place. We're going to win this year, though. I'm confident in that. So got my
All
running
right. I'm
down.
going to hold you to that.
That's right. Well,
Amazing.
speaking of winning, right? I think we had a really good catch up before the show. Real estate deals are structured like a million different ways. I think a lot of people don't realize that you can actually be participatory in more than just being a partner in real estate or actually owning the real estate. You can benefit from debt, pref equity, common equity, different structures. And I think investors in pilots sometimes don't really understand all the ways in which you can get paid in real estate, which I think is really cool. But I think more importantly than that is when you invest in a real estate deal, you kind of got to look up at the capital stack and say, what is the order in which I'm actually going to get paid?
Exactly.
Because that is how I right size the risk. So I think that's what we're going to get into today. Tate, what are your thoughts on this?
Yeah, today we're going to unpack the capital stack. And that's sort of a technical term, a jargon term that we use in real estate to look at the layer cake of debt and equity that all comes together to take down a deal. You can think of this as when you go and buy a house, typically you don't buy it 100% cash, right? You get a mortgage. Sometimes you might do an 80-10-10 where you do a 80% senior loan. You close simultaneously on a HELOC for 10% at closing, and then you put 10% of your own cash down. That is a capital stack. And we're going to go into how these capital stacks work when you're buying commercial real estate, how you can participate in each one of those segments, and who gets paid first in all of that, and the different risk profiles of participating in each one of those.
Absolutely. Well, with that, let's get into it. Let's get to the show.
Welcome to Passive Income Pilots, where pilots upgrade their money. This is the definitive source for personal finance and investment tactics for aviators. We interview world-renowned experts and share these lessons with the flying community. So if you're ready for practical knowledge and insights, let's roll.
All right, Ryan. So we're talking about the capital stack today. We're talking about common equity, pref equity, or preferred equity, the senior note, which is usually the largest capital partner in a deal, is going to be the bank. And then some different debt structures, mezz debt, bridge debt, things like that you can bring into a deal. And there's all these levers that you can pull. And those levers can either increase or decrease risk on a project. And we're going to talk about how you as an investor can participate in each one of those categories. So Ryan, where do you want to start here? Do you want to start bottom up or top down? Here's the first thing I'll ask is when someone says you're at the top of the capital stack or I'm at the bottom of the capital stack, what does that mean?
Well, let me just start with a little bit of a framing of this, right? So I think one of the most important things when I look at a deal in real estate, somebody always, like Tate, you probably get asked this like 100 times a day. Like people ask me this. They're like, how do you evaluate doing a deal, right? And how do you go about like unpacking a deal? And the number one thing that can go wrong in real estate, the number one thing that can go wrong in commercial real estate, whatever you're doing, is the debt. That is what screws everything up, right? So if you have a piece of real estate and you own it and there's no debt on it, chances are, unless it's something catastrophic, chances are it's going to be fine, right? So it's kind of like if I don't fly my airplane and I never take off, I'll never have any risk, right? But then it's like, what's the point of the airplane? So then when you layer on a lot of debt, like when you put on like 90, 95% debt, that's when your risk starts to pile up. But I think what we're going to talk about today, and to answer your question, the being at the top of the capital stack or being the most senior person who's going to get paid first lowers your risk, right? So if you're a first position lien holder on a property, which means that you're a bank traditionally, or maybe you're partnering with somebody and there's no debt and you're acting as the first position, basically that means that you hold a promissory note, you have a deed of trust recorded against the property, like you are in the front, right? So even if the property is like highly levered and you're the first one getting paid, that might imply that, you maybe carry the least amount of risk, and this is why you get paid the least, right? So
Right.
typically if you're a bank right now, like you can go out and get a 5 or 6% loan. If you're in the first position, you're getting paid first, so you're going to take the lowest risk and you're going to have the lowest reward. And so whatever comes after that is starting to take more risk on and should be compensated for the risk that they're taking, right? So when you think about a deal, you look at a deal and you're like, okay, this deal has no debt on it. That deal has a less amount of risk than a deal that has a lot of debt on it. And then when you're investing in that deal, and we're going to get into this today, you can be in any part of that deal. You could be the senior lender, so you could be at the very top of the capital stack, right? Or you could be a mezz lender, which is usually like a debt fund or like a second note or something like that. Then you could be preferred equity, and
Yeah.
then you could be common equity. So if there's a lot
Right.
of layers that got to get paid before you get paid, you might be, kind of low in the stack. So to answer your question more directly, Tate, if you're the top of the capital stack, that means you theoretically have the least amount of risk. And then it usually means you have the least amount of reward, which means you just make a simple interest or something like that.
Right. So excellent explanation. Thank you for that. I want to back up to your scenario of buying real estate 100% cash. And, a lot of pilots out there are, racing to pay off their homes, which I get. But, the reason they're doing that is because to them, it implies that there's less risk, which I'm not going to fight people on that. If you own a home and it's free and clear, fantastic, good for you. And we can get into the merits of, borrowing against that asset and using those proceeds to invest in other assets to grow your wealth. But in terms of purely talking about risk, buying real estate 100% cash, your risk profile is exceptionally low. Let's rewind back to 2007 and let's put ourselves in the shoes of an investor who was buying rental property right before the market crashed in 2008, and they bought at the peak of the market. And you paid 100% cash for a property. Say it was $1 million, and the value of that property craters to 750 or 700,000. Do you really care? I mean, your property taxes are probably what? I don't know, $500 a month. You're probably renting that property for $5,000 a month. So you're making a clip on that, and you're going, okay, well, the value came down, but I'm not really stressed because I don't have a debt service payment to make. It's pure cash flow. And this is why Dave Ramsey, God bless him, promotes this, is because now you're pure cash flow. You don't have that heavy debt service load to pay. And so those people that bought 100% cash in 2007, sure, mistimed the market a little bit, but do they really care the value of the asset came down? Not really. It'll recover. It's cash flowing in the meantime. Compare that to somebody who levered up that property 90%. They put 10% down. So they put $100,000 down. It's worth $1 million. The bank came in with 900. That's the capital stack, right? So you've got 100,000 in basically what we would call common equity in a commercial real estate deal. And you've got $900,000 worth of senior debt. And the property value collapses to that same $700,000 level. You are now what we would call underwater. And you're having to pay a monthly mortgage payment now on a property that's worth less than the debt that's on it. So very bad situation where you owe the bank more than the property is worth. And that's an extreme example of how you can look through the lens of risk. And it cuts both ways. If the property value goes up, then you as a common equity investor, as the person who owns it and puts the down payment on it, you own all that upside. The bank doesn't take a cut of the property the increase in equity, the increase in value, if that property goes up in value. And that's why it's called leverage, because you're amplifying your returns, but it cuts both ways on the downside. So Ryan, I'll turn it back to you.
No, I love this because when you think about high leverage and risk, part of it was, the value going down and you're underwater in values. That might mean the bank calls your note, or that might mean you can't service the debt payment. And you threw out a bunch of terms, and I really don't want to leave the pilots behind here on terms that I had no idea what these meant before I got into this stuff, right? Common equity, that sounds so sophisticated, right? Like it's a financial term. All that is your down payment, right? So if you buy a house, you go to a company to get your loan, you have a loan and you have a down payment. The down payment is common equity, right? So like when you're thinking about investing in real estate or a syndication or whatever, you're talking about the common equity is sort of the down payment. And so you are an owner, you are a partner in that LLC or that real estate, right? As a common equity holder.
Yes.
You are sharing in all of the upside and downside, right? You're sharing in the deal going completely wrong and losing all your money, and you have no recourse, right? Like you can't file a lien or anything like that. You're done, right?
Right. And this is what happened back in 07. This is why a lot of people just filed bankruptcy, right? They just walked away. They're like, I'm just going to stop paying my note because they just gave the keys to the bank. They're like, you take it.
Yeah.
I'm out.
And you mentioned senior debt. And I just want to make sure that the listeners understand that. So senior debt is effectively the bank, right? So if you buy a house, you put down a down payment, that's your common equity. You go get a mortgage, that's your senior debt. That's like the simplest capital stack. In fact, the capital stacks that I do for my real estate deals are a simple capital stack. We have common equity and we have senior debt. There's usually not anything else that has any sort of claim against the property. I think the next phase of this where it starts to get confusing, and common equity is definitely the term, is you start having terms like senior debt, and then you have mezzanine debt, right? And mezzanine debt can come in different forms. It could be like a second position loan. So they're second in line to the first position. And then you might have something called preferred equity, which is, again, it comes with terms and conditions that aren't necessarily like a lender, but that person could be owed money based on a very stringent thing with limited upside. And then you have common equity. And I think what's really important, and sorry to go on a tangent about this, but if you're a common equity investor, the first thing I should ask is, what are the layers in the capital stack? What other debts or encumbrances are going to be on this property? Who else is ahead of me in getting paid? Right. So I think this is the big takeaway is like, okay, I'm a common equity holder. This looks like a great deal. It pays, it's projecting a 20% return or whatever it is annually. And you go, okay, I'm making a 20% return, but there's preferred equity ahead of me.
Right.
There's a mezzanine lender ahead of the pref equity, and there's a senior debt holder, and they've leveraged 90%. So the chances of me actually making 20% after all those layers are passed through is like zero. Right
now,
but
I will say, if it's levered up like that, if it goes really well, you stand to make a lot of money.
Yep,
because it's so leveraged.
Exactly, and I think a great conversation in the other direction is if a property isn't that leveraged and there's not a lot of layers, then the risk is somewhat lower. Right, comparable deal. If you're comparing deal A to deal A, and one has all those layers, and it projects a 20-something% return. And then the other deal, same underlying asset, but it has just common equity, senior debt, and a lot less leverage. And like you should expect that return to go lower, like 5 to 7% annually lower, because you're just looking at this and you're going, well, this doesn't carry as much risk as all these other layers, right?
Right. I want to back up real quick and pose the question, if buying real estate 100% cash is so safe, why doesn't everybody do it? Why don't you just buy your deals with 100% cash, Ryan? And then, you wouldn't have to have all this risk. And the answer is, if you're going to buy $1 million house, you probably aren't going to wait until you have $1 million of cash in the bank to do it. Similarly, a house might not even be the best analogy in this situation. Let's say that you start a business and that business is hauling oranges from the orchard to the supermarket. And in order to get the oranges from the orchard to the supermarket, you need a truck. Well, would it not make sense to go and get a loan for that truck so that you can generate returns to pay off the debt? That is what we would call good debt, because that is productive debt. It is buying an asset that is generating revenue for you. It pays for itself. You wouldn't want to sit around and wait until you had 70 grand in your pocket to go and buy that truck so then you could make the revenue. That doesn't make sense. This is the whole premise of debt, is lending money, borrowing money so that you can acquire an asset that generates a return. So if you now shift back to, let's say, a self-storage unit, we're going to borrow money in order to lever up that deal. First, to magnify the returns, because if we were to buy it 100% cash, you're going from $1 million asset to a $1.2 million asset, you're going to make 20%. You lever it up by 50%, meaning you take $500,000 of down payment and $500,000 worth of debt. Your returns are magnified. You're still making 200 grand or 20% of asset value increase, but it's on 500 rather than on $1 million. You're lowering the denominator in that equation. Hopefully this isn't too rambling, but
can I give it short? Can I shortcut it?
Please.
So there's a term in investing called return on invested capital. When you have leverage, your return on invested capital goes up. When you don't have leverage, your return on invested capital goes down.
That's it.
So if you're like, why is there debt? So that equity can make more money.
That's it.
Yeah, and if you have, I get this question all the time from investors. They're like, why don't you just do this all cash? It's like, well, if I did this all cash, then your return would go from like a 15% projected down to like a 7%, right? And so because you're a return on investor capital, you have more mouths to feed as equity holders. If you put it, and don't even think about number of investors, think about dollars, right? If you take more dollars and put it into a deal, then all those dollars are going to make less return unless you find friendly dollars that come in at a fixed interest rate that's lower, right? And that they take up some of the space at a lower assumed rate with no upside, right? So call it a 6% loan. Your return on invested capital is going to go up. And so I think that's why it's interesting, like commercial real estate right now, like where it's at is, it's hard to have a good ROIC right now because interest rates are really high, right? Or higher than they've been. And the price you pay for real estate is still a little bit on the high side. So that's good. One thing I wanted to say though is like one way to increase your return on invested capital, and that's a term, ROIC. The one way to actually make that more efficient is to find the most efficient capital structure, right? So if you go to a traditional bank, they're going to give you a loan and the loan might be 6 or 7%, whatever it might be. And then you're going to go to a common equity holder and you might say, hey, I'm going to give you this much money if you invest in my project. But the reality is, if you have preferred equity coming in, the preferred equity is going to have a lower overall return potential than the common equity. So now you've added a layer into the capital stack that then makes it more lucrative for the common equity to make money. And it limits their upside somewhat. Still great returns. It might be like a 5% current pay and a 6% kicker at the end or something like that. But it's going to have that, it's going to give that potency to make your ROIC go up.
Yes. And just so that you can visualize this, I want to make sure everybody's following along here. Preferred equity is going to sit sandwiched in between the senior debt and the common equity. So the common equity would be at the bottom of the capital stack. They're going to have the largest upside potential because they're pure owners in the deal. They're the down payment. They're participating in every bit of the upside of that project. The senior debt is getting a fixed rate of return, but they are not participating at all in the performance of that project. They want their interest payment and they want their money back. That's it. The pref equity piece can come in and it can sit ahead of the common equity in a preferred payment position, meaning they have to get paid first. But just like you said, it's going to be at a lower rate of return than what the common equity investors have. It might be, like you said, some sort of current pay. Maybe they're receiving 5 to 7% cash flow and then a kicker at the end. but they get paid first. So if the deal doesn't perform as well, they're in a much safer position.
Yeah. I think there's a lot of benefits to preferred equity. And I think there's some things that you might want to just stress test on a deal. So, when you're thinking about pref equity and being an let's talk about you being an investor. Like you're deciding to actually do a pref equity deal. My first question would be, what is the overall senior debt, or what's the debt ahead of mine, right?
Right.
Because you really have to size up, the current pay means, like if I'm a pref equity investor, let's just make something up. The current pay is they're offering 6% as a preferred equity holder. That might mean if we put in $100,000, you're expecting to make 6%, right? You're just making $6,000 on your 100K investment. And your future upside could be when the property sells, you could make another 6%, let's just say. And that would have to be paid before the common equity. So before the equity that's behind you. And that's great. But in this market, there's been a lot of pref equity that has been offered. It's been a sort of a tool to sort of come in and sort of save a property that's potentially under like drowning, right?
Yeah, rescue capital. Yeah.
So I would make sure that the senior debt, I'd pop the hood on the senior debt and say, how much debt is ahead of me and what is the leverage to the actual value of the asset? And then what is the ability to actually, like, what is the upside potential, right? Because you still have to have upside potential in order to, make that 6% at the end or whatever the terms are. So,
okay, you're going a little deep here. So I want to make sure that everybody's tracking. What Ryan's talking about is, let's say a project, it's worth $10 million. And the original capital stack was just common and senior debt. And let's say it was a 70-30, I should say it's 70% senior debt and 30% common equity. Not overly leveraged. That's a good deal, right? But, because the real estate market took a heck of a beating after interest rates rose in 2022, there has been an across the board reduction in commercial real estate values over the past 3 to 4 years. Do you agree with that?
Absolutely. Yeah.
So that $10 million asset might now only be worth 8. And the cost of servicing the senior debt may have increased dramatically. And so the property that was originally cash flowing nicely, like your rental property's cash flowing, you can imagine if your mortgage payment went from $3,000 a month to $6,000 a month, you'd be hurting, right? And that's exactly what happened to a lot of these projects. Is the cost of servicing that senior debt went up dramatically overnight. So all of a sudden you have a property that's negatively cash flowing that is worth significantly less than what you paid for it. And, just like when you're flying an airplane and thrust and drag need to be in equilibrium in order to stay in level flight, if your drag dramatically increases, cargo door pops open, a parachute goes out, that's like what you can imagine when you have this increasing cost of debt. Now your airspeed's bleeding off. And what do you have to do in order to not stall? You got to pitch down. You got to start eating into cash reserves. You got to pay the bank. Bank has to be paid. Otherwise, they're going to take back that asset that's now worth $8 million. Remember, the bank loan is at 7. So the bank would be thrilled if you stopped paying, because they're going to take back an asset that's worth $1 million more than what you owe them. So you do not want to let the bank take that back. You want to keep feeding the beast. You want to keep paying that mortgage. However, the asset itself is negatively cash flowing. So what Ryan is saying is that a lot of times in recent history, we've seen a sponsor on that deal say, hey, we need to bring in additional capital into this deal. And they'll do that through a pref equity offering. And so they'll split the capital stack between the common and the senior debt, and they'll wedge in, let's say, $1 million worth of pref equity. And they'll say, listen, common equity people, sorry, but if we don't do this, the asset's going to go back to the bank. You're going to lose all your money. So we're going to bring in $1 million worth of this new capital sandwiched in between the senior debt and you. They're going to get paid back first, maybe a fixed rate of return or some sort of a hybrid of current pay. Because once they do that, they're probably going to be able to pay down some of that senior debt, get their cost of that debt service down, might return the property to cash flow positive status. And so they're going to be able to generate some cash flow in the current market or in the current day. and they're going to use that to pay the pref equity. And then when the project eventually, hopefully sells, they're going to have to pay back the bank first, and then the pref equity, and then the common. And the whole game right now is sort of, there's all of these projects out there that are trying to limp their way through this tough time in commercial real estate to get into some greener pastures where they can sell this thing for maybe 10 million, 11 million, 12 million, more than what they bought it for, so that they can pay everybody back. But I wanted to provide some context there because you were talking about rescue capital and pref equity. And I just want to give some context in terms of where that's coming from.
And I love your stall drag analogy, because before doing a pref equity deal, like if you're going to be an investor in that wedged in save, how much altitude can you lose in the stall?
I always say that altitude, if you look at that 172 analogy, I'm sorry to cut you off, your altitude is your cash reserves. So how long is it going to take you to burn through your cash reserves in a glide if your motor quit, right?
Yeah, and I wasn't really talking about cash reserves, but I mean, if that asset is really actually worth 6 and they're wedging in, $1 million and you're still upside down, like you could be investing pref equity into a deal that never recovers, right? And then as a pref equity holder, you could not be paid that current pay, because usually the terms in pref equity is, hey, if you don't get paid current pay, then you start getting ownership in the deal, but who cares? The deal's dead. It's upside down, right? So
exactly.
I cash reserves is part of it, but I would say that, where I was going with it was, you say the deal's worth 10 and now it's worth 8, but really maybe it's worth 5 or 6, or maybe the cash flow can't even service the pref equity. So even though there is a current pay, there's still massive risk that you can't make that current pay, and there's risk that you won't get. So it's kind of like boarding a plane is stalling, right? And so you have to, like, you're getting on something a vessel that has a problem, right? And I would go into a deal like that wide open, just being like, hey, we know that this deal has a problem and that I'm stepping in to fix it. And I need to make sure that I have clarity on this plane having enough altitude to actually recover the stall. And I have to know that the person who's flying the airplane knows how to do stall recovery, right? And so, how many times have they done this, and what, and so it well-trained and things like that. Because I think, pref equity can be used a couple different ways.
Well, and before we get to that, I really do want to stop and just say, we're not trying to beat up pref equity here. What we're talking about is rescue capital going into deals. And typically the way that you would see pref equity being offered, the way that we're talking about it up until this point, is in a capital call situation. So you're already in a deal. It's not going well. They need fresh capital to come in. It's usually in a new pref equity offering. Now, pref equity is not always a bad thing, and it's not always rescue capital. There's actually very advantageous ways to use pref equity in new healthy deals. So let's talk about that.
Yeah. No, I mean, you just have to know what you're stepping into, right? So like a pref equity deal could be, hey, like this deal, like we actually, one of our deals that we did last summer, the property management company CubeSmart actually offered us pref equity, right? And it was really, really attractive pref equity terms. Now, I want to get into some of the ethics too, but I just want to touch on that. We could have started that deal with pref equity, right? And it was like I think like a 5 or 6 current pay and maybe a 4% kicker at the end, which is like cheap pref equity, right? And that kind of sizes to the risk, right? Because they didn't view it as a very risky pref equity play. The reason why we didn't do it is because we already had told the investors that they're investing in a common equity and a senior debt deal. I understand when you're desperate, you kind of run out of options, and maybe pref equity is the only way to go do that. But, when you're looking at being a common equity investor, or just, the bottom of the capital stack, the most risk, the most reward, I would ask your sponsor if there's any provisions that allow them to put pref equity ahead of you later on in the deal. Because if you could imagine, it's like the hawk circling the carcass, like, yeah, okay, I want to be a pref equity investor, and I'm going to come in and I'm basically going to squash any hope that these common equity investors have to make a return. And like, sucks to be them, but great to be me, because I've determined this deal is awesome and it has a lot of altitude to recover from. And I'm now ahead of these guys that have been, these investors that have been in the deal for 4 or 5 years. Pretty upsetting to those investors. But maybe those investors had a chance to invest on the pref equity side, or maybe the investment had a capital call and they tried to shore up money to try to save the deal and no one participated, right? So it's really important to kind of go into things and kind of understand what could happen in the future and ask if there's any provisions that would disallow that.
All right, I'm going to play good cop with pref equity because I'm going to defend it a little bit because we did an apartment deal last year when we structured it from the ground up. Amazing deal. We bought it for, 60% of what it would have been worth a few years ago. The guy had owned it for 35 years, unfortunately passed away. His heirs were selling it. Had they sold it a few years earlier, they would have gotten a much better price for it. But remember, if you've listened to our episodes before, you know that he would have paid capital gains tax and his kids get the step up in basis after, a family member's death. So the kids inherited it. They decided they didn't want to wait for the value to go back up. And so we got it at a great basis. The reason we did a pref equity piece in it was to appeal to different investor appetites. The primary equity in the deal was common. We peeled off, I don't know. I think it was a $10 million deal, very small. And I think there was about $3 million in common and about $1 million in pref. And the way we structured it, I think it was 8% current pay. And then at the end, they would get bought up to a 13 or something like that. That was very attractive for a certain subset of investors who were maybe in their late 50s, 60s, in retirement. And they're like, yeah, this is a great deal. There's a lot of meat on the bone, but I don't want to get greedy. I'm happy with that 13% when the deal goes full cycle. And I'm the first one in line to get paid after the bank, of course. For the common equity investors, they have the opportunity to make 20+% on the back end. They're also getting some cash flow. Deal's going really well, but the pref equity investors are getting more cash flow with limited upside and they're first in line to get paid. The common equity investors are getting a smaller amount of cash flow with a lot of upside as this project matures. And if you're in your earlier, more gladiator phase of your career, you're making tons of money, you don't necessarily need the cash flow, and you're looking for more of those doubles and triples, that could make more sense for you as long as you're comfortable with the risk profile of that deal. So I think having the option on a deal to either go, hey, I'm going to take a little lower risk, I want to be first in line, I'm happy with this lower return, or you look at the deal as a whole and you're like, no, this is really healthy. I like the deal overall. And I can see that there's a lot of upside. The pref equity people are not going to be participating in that upside. The common equity people are.
Yeah, I think what you're explaining though, is you're explaining somebody who's offered a deal transparently.
Correct.
And
which should be the case
from the beginning, right? Like you're
Correct.
basically saying, hey, I'm going to do this thing.
Yes.
I just think the big takeaway there is like, if you're a common equity holder and you go into a deal and there's pref equity, just know that you're now and there's debt. Now you're the third in line to get paid. I would expect my return to be much higher than a deal that comparatively didn't have pref equity, right?
And mathematically, that's the case, because if you were to convert everybody in that deal I just mentioned to common, the return on the common equity would be lower because the cost of capital is going to be higher.
Your ROIC, return on investor capital, right?
Correct.
Like that's where you're kind of thinking. And again, return on invested capital goes up with more leverage or more people that are taking less, right? Banks, pref equity, but your ROIC goes higher, but it bears more risk.
Correct.
As you lower the leverage and you lower the people in line to get paid, your ROIC goes down. So that's why I cannot stand it when somebody's like, hey, Ryan, we look at this deal, the returns are fantastic. Your deal pays 13% and this deal pays 21% or whatever. Right. And I'm just like,
first of all, those are all projections.
First of all, they're all projections, but you haven't given any credence to how you actually are lining up in the capital stack and who's getting paid when and what your risks are, because it's kind of a silly comparison when you don't have those factors, right? And I always love giving the analogy of like, it's like skiing a ski hill, right? A common equity and senior debt with low leverage is like skiing the the green circle. Yeah, the green circle, right? Easy peasy, baby. Like no problem. You want to go to the blue square, you lever up a little bit. You want to go on the double black, or you want to go on the black diamond, right? Now you're skiing, you're having a good time, but like you could fall and hurt yourself. And if you're not very good at skiing and this is your first time down the mountain, maybe avoid the black diamonds because you're going to probably have some senior debt, maybe some second position debt, right? You go ski the double blacks and you're sitting common equity and you got pref equity and senior debt, maybe some mezz debt. You are skiing a double black diamond, right? Yeah. And you kind of better know what's going on and don't do that for your first one. Maybe like it's okay if you do, but like you just might be careful, right?
Okay, so I want to flip now from talking about it from the investor's point of view to talking about it from maybe our point of view where we're putting deals together. And what we typically do is we're going to identify an asset. We're going to figure out how we can make it worth more and by how much. And then we can sort of back into the capital stack. What you don't want to do is take a deal that's already really risky, and lever it to the hilt. We did, for example, a land entitlement deal in Colorado. Deal's going fantastically, but land entitlement inherently is very risky. So the worst thing that we could have done was take out a bunch of debt on that deal. We bought that 100% cash because that gave us runway and breathing room, and we were able to execute a fairly risky business plan on this deal without the added risk of needing to make sure that the bank is paid so that we won't lose everybody's money. There are other deals that have inherently low risk, like let's say the Houston storage portfolio. A lot of listeners invested in that. That is a deal where now you start backing into, okay, here's the deal, here's how much it's going to make, and now let's start putting the layer cake together. How much debt should we take? So I know that one was actually fairly low levered. I mean, we probably could have gone a little bit higher on that deal. Spartan could have gone a little higher on that deal. But what were the things that you were thinking about when you were structuring that capital stack, Ryan?
Yeah, number one, I know that our investors want cash flow, right? So if I went in and said, I want to put common equity and pref equity and senior debt on this thing, I know that the cash flow would have gone very low for the common equity investors, right? And so when you think about the cap rate you're paying on an investment and the interest rate that you're going to pay on the debt, it gets harder and harder to cash flow when you have higher and higher leverage. Like there's an advisor we had, Brandon Bruckman, who literally has deals called zero coupon deals. And I won't get into like the reasons why he does them, but zero coupon is like high leverage, no cash flow, right? And so when we were putting this together, we thought, hey, let's make it so the common equity investors are going to get some cash flow. Also, this is a big deal. This is a $107 million, $108 million deal. And we didn't want to take a lot of risk. We just wanted to make sure that we could cover our debt service, and we wanted to make sure that we could execute our business plan. The other thing that we strategically negotiated into that loan is that if we were hitting a certain DSCR at the end of year 3, we could actually go take more money out. And that way, like we could, if the cash flow goes in the way that we want it to, we could take more money out later or not. We have that option. So I think when you're thinking about, how to leverage something, I would decide, when you're looking at something like low risk deal, low risk underlying assets, proven track record, and then you have low leverage, you shouldn't be expecting crazy returns. If you have an inexperienced operator, I would say that I would expect more returns.
Yeah.
If you have an inexperienced operator and a class B or worse asset, class C, class D, whatever asset, then I would expect much higher returns. If that operator then levers the property up with all kinds of different layers of the capital stack or high leverage, and I consider, and I know this is my personal preference, I consider anything over 70% being incredibly high leverage, but that's just me. I know a lot of operators do like on the reg, they do 80 or 90%, but I consider that risky. Those to me, that would be like a 30% return, new operator, highly leveraged, low quality asset. I would want to see something crazy on the returns, right?
In order to make it worth the risk of going into the deal, or?
Yes. Now, if I see experienced operator with low leverage on a Class A asset, I don't expect the returns to be very high. Like I would expect, somewhere in the low teens, like maybe 13, 14%. And so that's how I size a deal. And I think investors really, this is so important because as this pilot community gets more exposed to this type of stuff, I think that's where we really have to get good at saying, if somebody brought me a deal, I wouldn't even look at I wouldn't, I would say, okay, what's the sponsor? What's the debt? Where are you in the capital stack? What's the quality of the asset?
Right.
And then I would say, again, I would put it through my test, which is like highly levered, inexperienced, low quality asset. I would say, okay, that should be a very, very, very high return, right?
Well, and there's also, the less experience the team has, the less dialed in they have their numbers. And so
right.
they might be projecting a 30% return and then find out later, like, oops, it's only going to be a 15.
Yeah, exactly. And that's where but as an operator, I mean, I'm very risk adverse. I don't want to have, any deal I've ever gotten into trouble with in real estate has been because it was levered too much.
Yep. 99 times out of 100, anytime you hear anyone say that they lost money in real estate, it's because of the debt.
Because of the debt, every single time. Yep. And, and it's, or the ability to restructure the debt. There's some times where, Tate, I know you and I are in a deal right now, we're restructuring the debt and that makes it a lot better. Right. And so,
yep.
And the only other thing I'd put on there is fixed rate versus floating. That's like another big one.
Yeah.
Is your senior debt or your mezz debt a fixed rate or floating? And I think that's, if the debt can change, right? And I know for a minute we were in a lowering interest rate environment. Now it seems with the new Fed and inflation and conflicts overseas, I feel like we're kind of in this. I think we're predicting 2 rate hikes potentially through the end of the year, right? So I think all bets are off. I think people kind of took, floating rate became more popular recently because everyone's like, oh yeah, rates are coming down. But now I'm kind of like, we're looking at stuff and I'm still on the fixed interest rate bandwagon, right? Because I'm like, so.
You said something earlier, DSCR. I just want to clarify that. So that's debt service coverage ratio. That's essentially any debt service coverage ratio of greater than 1 is basically going to be a surplus of thrust to drag. So you're going to be able to clear your debt service coverage and you're going to have cash remaining. Anything less than a 1.0 DSCR, you have a negatively cash flowing asset. Banks like to see about a 1.25x to call it a healthy deal. Anything more than 1.25 would be a big thumbs up. We talk about risk and leverage in terms of loan to value or loan to cost. DSCR is kind of that same metric for cash flow. So the higher the DSCR, debt service coverage ratio, is how much cushion you have on cash flow above and beyond the amount that it takes to service your monthly debt payment.
Love it. Well, this was a awesome discussion.
I think so.
I hope our listeners took away where you stand in the capital stack and what's going on with these deals. And our whole goal today was to make you a little bit more sophisticated and also expose you to some opportunities in real estate that maybe you didn't know about.
That's right. Because you can participate as common equity, pref equity. You're probably not going to be participating as senior debt because that's typically a bank. But before we go, we should probably touch on mezz debt or bridge debt. Really mezz debt, because you could potentially see an opportunity to invest in some sort of a private credit fund or a mezz debt fund that comes in as a secondary lender on projects. Do we want to touch on that real quick?
Yeah, I'd love to. I mean, probably one of my favorite ways to invest, frankly. I would consider mezz debt like a private debt fund or something like that.
Same.
Something
private
that
credit.
may or may not be in the first position. Usually it means second position, as in like a mezzanine, right? A mezzanine level is half. It's above, right? It's not the ground floor. It's mezzanine. And so if you think about, you're coming in and you're getting some kind of a higher interest rate, but you're also usually in a subordinate position. You're not the first in line on the debt side, but you might be the second in line on the debt side, which means that you may or may not be secured to the investment, right? You might not be secured to the property. So if the property loses money and there's a foreclosure or something, you might not have the right to file against the deed of trust, or maybe you do, depends on how it's structured. Right. So I would say, if you're in the mezz debt position, just understand the mechanics, right? Like where are you? How does it get paid? What's the limits on LTV? Things like that.
I would also just point out, how much cushion of equity do you have behind you? Because if the senior loan is at, let's say, 60%, and you are in a mezz debt position that accounts for 10, then you have 30% equity behind you. That would mean that the asset would have to lose 30% of its value for you to start taking a haircut. That's a
right.
pretty safe
Yeah.
position. So, if you're looking at the market and you're like, yeah, I don't really think that we're going to see valuations collapse by 30% anytime in the near future. I'm comfortable and I'm getting a nice, 8, 10% rate of return, something like that. That could be a really healthy mezz debt position to have in your portfolio. Could.
Yeah.
Now, on the contrary, if the senior loan was at 80% and you're in a mezz debt position that accounts for 15% and there's only 5% of equity behind you, now the valuation only has to collapse by 5% and now you're losing money. So the amount of equity cushion that is subordinate to you matters a lot.
Yeah. And I would say this too, like, I go to like local real estate meetups sometimes, and you do run into, to your point about not being a first position lender or senior debt lender. Those opportunities are out there. Like, I know a lot of investors that are hard money lenders, right?
Yeah, I was going to mention that. Yes, that would probably be the most common way to act as a senior lender.
Yeah. So hard money lenders can be first position, right? And that can be very lucrative. Yeah. Again, where you get into trouble is, if you might be a hard money lender, you might be investing in a hard money lender fund, right? So you have a manager who goes out and makes these loans and finds these projects, and you're an investor in that. And where I see they'll go wrong is they put a loan out on property that's highly leveraged. The deal starts going poorly. So what do? They throw more debt on it, throw more debt on it, throw more debt on it, to the point where there's debt is exceeding the value, and then you can't get your money back, right?
Right.
But I've also seen people make a lot of money, right?
Yeah.
Being hard money lenders, because here's usually what you get to have in first position, right? You get the first position loan. At closing, you get paid 2, 3, maybe 4 points. So if it's $100,000 loan, you're making $4,000 at closing. If you're getting 4 points, you're making 12 or 13% interest. You're the only one in the capital stack, right? The hard money borrower is just trying to turn these properties as fast as possible and pay you back as fast as possible. And then when that loan pays off, they want to do another flip, right? Another house. So what do? They borrow again for you at 4 points.
Right.
So now you make another 4,000 on your 100,000 example, and the interest in the interim along the way. You do that 3, 4, 5 times a year, you could be making 20 points on your 100 grand. You've been making 20 grand just on closing points, right? And that's huge. And that if they screw up that flip, all you got to do is, you're the lien holder on that property now. You're in first position. There's no other people involved. Take the property back. Now, you probably don't want to do that.
Foreclose on it. Yeah.
Yeah. But, I know seasoned investors who do this 9, 10, 20 times a year and make a whole business out of it. The key there is you got to really know the market. And I would probably want to live in that market.
Yeah.
Right.
And you're going to want to know the borrower as well. They tend to crop up as these symbiotic relationships between flipper or builder and investor. And they'll form this symbiotic relationship that lasts for 5, 10 years. And they just sort of follow each other from project to project. That's how I've seen it manifest.
Totally. And so that's a great way to be a first position lender. Some funds will offer you the first position, right? You can invest in funds that do that. I think there's been a lot of negative press about private credit funds as of late. They were like, they were sort of like the in style thing that everybody was doing, because what was happening was, and private credit kind of falls in that mezz debt category. What was happening was, you were having these commercial real estate deals get into trouble, and then you'd have these private credit funds swoop in and sort of lend in an environment where it was really hard to get lending. And, I think with the Blue Owls, if you Google Blue Owl and what happened there, like a lot of investors started to ask for liquidity and they didn't have it. Right. And so these loans were getting extended. They were trying to get, investors were trying to call their cash back. They didn't have it. Right. And so I think we've seen this sort of commercial real estate lending thing drag on. And a lot of these private credit funds haven't been able to offer the liquidity that the investors were sort of expecting. So just know that, like, redemptions are never guaranteed, and you can't always
Yes,
get your money back. And be careful, because I've had a lot of investors say, "Hey, can you look over my shoulder on this deal that I'm looking at?" And I'm like, "Hey, ask about redemption. What are the terms of redemption?" They
absolutely.
might say something like, "Oh, we've never not been able to redeem." And it's like, "Whoa, whoa, whoa! But what if you can't?" Right? And that's a real risk.
I do want to unpack this because we have a private credit fund, I'll just, full disclosure. And I want to make sure that people really understand this. I was just at the Fact Right conference in Scottsdale, Arizona, a lot of broker dealers there and family office money. And there's a panel on private credit. And really, everybody in the room was saying, the headlines on private credit are completely overblown. These funds were never meant to be money market funds. So there's two issues. One is the one that you just mentioned, that
And when you
there are
say
a lot
money
of,
market, what you mean is money that you can just withdraw whenever you want, right?
yes,
Yeah.
yep. It's making a rate of return. You can click a button, same day liquidity, turn it into cash and put it somewhere else. Private credit funds were never intended to be that way. I know that, Ryan, you have a debt fund, operates a little bit differently. Ours has a 2-year lockup period and then 90-day liquidity after that. But of course, we always disclose that it is as we can. You can think about it like a carousel or a Ferris wheel, where people are coming on to the carousel and people are getting off of the carousel. And you structure a private credit fund with it's a huge basket of mezz debt, bridge debt. And we've got some pref equity positions in there as well. None of it's rescue capital. It is all, has super
So
healthy
just originations,
equity positions.
acquisitions.
Correct.
Yeah.
Correct. And you stagger the maturities so that when someone says, "Hey, I put 100 grand in this, a couple of years ago, I want my 100 grand back out." Great. We've got a maturity coming up in 2 months. There's going to be, some liquidity in the portfolio. We'll cash you out in 60 days. Oh, look, John Doe just committed 100 grand into the fund. Hey, do you want to be cashed out today? Sure. Great. And it's a drop and swap. This person gets off the carousel, this person gets on. The problem is when everybody wants to get off at once, it's sort of that run on the bank situation where you can't, because you have this carousel of all of these staggered maturities happening within the portfolio. And so that's how a private credit fund works. And when it works the way that it's intended, then it's a beautiful thing because there's no volatility. Investors are getting paid a fixed rate of return. It's very, very low risk. But when people come into it with the wrong idea of what it is, that's what creates issues. They say, "I want my money back." And they go, "Well, everybody's trying to get their money out right now. We can't."
Yeah.
And they go, this is a Ponzi scheme. It's like, no, it's not. It's just you have to wait for all of those maturities to occur to get everybody off the ride.
Well, and I think part of the problem too is that, like, I see it all the time on LinkedIn where people are like, "Yeah, in our private credit fund, you can get your money back whenever you want." And it's like, no,
Yeah,
you can't.
that is
Nobody
the
can.
wrong.
Yeah.
If anybody says that in a private credit fund, run the other direction, because they're misconstruing or over promising what they can deliver.
Yeah, and ours is the same way. So we have a similar thing, right? Our private debt fund is 90-day redemption. So you can have a 8% at 90 days, or you can have a 9% fixed payment at 2-year redemption, right? And it's very simple. The documents will tell you, if you get into the legal disclaimers, it says this, right? And I always make sure everybody says, like, "Hey, I just want to read you your rights here," which is, you can call your note back 90 days prior to our redemption windows, which we have a window in February and a window in August. So 90 days prior to those dates, you can call it back if you're in the 90-day redemption period, right? And it's first come, first serve, and it's only if money's available, right? Is kind of like the thing. If there's not money available, we can't make further loans. So if we get to your redemption window and we can't redeem you, we can't make any more loans with that fund until you're paid back. And that sort of stops the fund from lending out additional money, right? Until we've paid you back, which is in the redemption queue. The other thing is 2 years, right? Where you get a little bit more interest, but you're also tied into the fund a little bit longer. Think about it's like kind of how the yield curve works, right? Like longer time, more money. 2-year thing. And then 90 days after that, 2 redemption windows. You have to go between each one redemption window. So if you're not getting that kind of an explanation of how redemption works, you should probably be concerned.
100%. If anybody's saying, "Oh yeah, you get your money back out at any time," it's like, no, you can't. And that's why there's all these headlines.
Yeah, there was a guy selling a timeshare or like a portion of a Pilatus or something, a PC-12. And he's like, yeah, and you can get your money back after a year. And I was kind of helping the guy looking at the deal. I was like, well, can you ask him what happens if he doesn't have the money to give you back? And he's like, oh, well, we've always had the money. We've never had an issue. Well, of course, when everything is perfect, right? And like in the Blue Owl situation, I don't know all the details, but I probably could imagine that it's a big fund. They probably had some mark-to-market reporting come out, and the values of that real estate, I think, were going down, and the loans were pretty high. And so investors were probably looking like, oh, crap, they're running out of runway, right? And I want my money out before the thing shuts down on me. And so that's the thing is like when everything's going great, nobody wants, I mean, you might have redemption requests here and there, but when everything starts to go to crap, that's when everybody wants to call their money back. Same thing happened with Blackstone on their BREIT during like 2023. Everybody was trying to get liquidity, had nothing to do with their performance. And so they were like, there was all these requests that came in, and then that just begets more requests, right? Because everyone's like, oh my God, everybody's trying to get their money out, and then like, oh, I want to get my money out. And then everybody starts running to the back of the room to get their money out. So it's kind of like, what's that show? Mary Poppins, great scene, run on the bank, right? And I think like the kid says something or whatever. I don't know. I can't remember. Dick Van Dyke's in there, and he's the banker, and it's really funny. But like that's the panic that gets created. Then it creates headline panic, and then like you said, Tait, like the panel was just talking about it. But
but then at the end of the day, you read between the lines, you actually look at what's happening, and there really isn't an issue except for a small number of funds. Private credit is operating exactly the way it was intended to. And investors just need to come in eyes wide open, understanding that it is not a money market fund. This is a longer term play where you are locking your money up for a little while.
Yeah.
But they're very low risk and they pay a really nice rate of return. I'm a huge proponent of private credit funds.
Well, I think we're going to try to end it again. So Tait, this was good. We're at an hour here. So I think, thanks for following along with us while you make your commute to work or your drive to the airport or wherever you might be. If you want to jump into more conversations, join our Facebook group or join the conversation or send us an email. We'd love to talk to you about any of this stuff. Tait and I are happy to look at a deal you're looking at or look at or answer any questions that you have if something that you're evaluating. So very good stuff.
Excellent. Well, thanks, Ryan. This has been a blast.
See you on the next episode.
The Capital Stack.
The Capital Stack.
See you then.